Jonathan, a 50% retracement is a big deal is made of that. Where do you think the markets go from here? Because as I understand it, we don't usually make new lows once we've hit that 50% mark, but we have tested prior lows in circumstances such as this.
Yeah, I think it was significant that we closed above 42.31 on Friday because, as you mentioned, that is the 50% retracement of the entire bear market decline. And since 1950, we've never seen an S&P 500 have a 20% drawdown, retrace more than 50%, and then make new cycle lows. So I think from a medium or long-term perspective, the odds or history would suggest that those June lows are probably intact. Those probably are the lowest for the cycle. But as you mentioned, three periods that we would note that did see actually meaningful drawdowns pretty soon after that 50% retracement. One was 1974. You went a little bit higher, and then you had about a 14% drawdown. And then 2004 was a very choppy period. You basically went sideways for 8 months with a 8% drawdown throughout that choppy period. And then more recently in December of 2009, when we hit that 50% retracement, you also had about an 8% drawdown. So I think the message here is that from a long-term perspective, we could probably make the case that the lows have been seen, but that does not mean from a tactical or short-term perspective that you want to just flip everything and pile in all in long here, because we've had a pretty good run, and a lot of the indicators we look at are screaming pretty severe overbought conditions. So it would not be surprising to see a bit of a pullback here in the near term.
Joe, you got a question?
I do, Jonathan.
Yeah,
good to see you.
Joe, sorry.
Jonathan, good to see you. So how do you think the non-discretionary rules-based funds are going to factor in here? Because here's what's going to happen. As the market moves higher and you exceed these 200-day moving averages, which in the case of the NASDAQ, you really haven't been above with any degree of sustained momentum since early in January, you're going to see those funds step in and buy the market. Doesn't that lead to further acceleration that leads this recovery into the 60 to 65 recovery range? And how should we think about things then?
Yeah, I mean, look, those systematic funds work both ways, as you know, right? So they buy more as things go higher. Conversely, if we were to roll back over, they could become sellers. I would say that, the 200-day moving average is the next key level we'd be watching. It's important to note, though, it's declining pretty severely, and typically when you rally into a declining 200-day moving average, the first attempt is usually rejected. Not always, but that's a pretty good assumption. So our sense is, if you get any further strength, you get rejected off that. If it's important to then watch the reaction to that. If we kind of, base out sideways and don't give much back off that first rejection, then to your point, maybe there's more controlled buying as we push and move up that. But our assumption is that's probably not going to happen on the first attempt.